All right, so I'm going to introduce our speaker now. I'm going to read his bio. He is on the call, and I believe he's going to share his screen. So Mr. Jose Pedreira has over 35 years of experience in financial markets, including 20 years as a portfolio manager and 25 years directly involved in trading and risk positioning. In 2013, he founded Waypoint Asset Management, an investment management company specializing in emerging markets and focusing in distressed debt and special situations. In addition, he also serves as the CIO of EC Family Office in Mexico City and the CEO of Capital Saludable, founded Forum Asset Management, which specializes in, financial services, also in Mexico City. Sorry about that. Trying to sound like I read that word appropriately, and I apologize. You'll have to correct me when it's time, Jose. Prior to Waypoint, he founded Forum Asset Management, which specializes in global macro distresses and asset-based lending with investors from around the globe. At its peak, Forum managed close to $1 billion in different investment vehicles. Previous to Forum, he was a partner at Columbus Group, an asset management company with offices in Greenwich, Connecticut, Mexico, Caracas, and Seoul. He was a managing director and the head of emerging markets trading at Merrill Lynch in New York, and he began his professional career in the financial sector at Citibank, Caracas. He holds a BA in administration from University Francisco de Miranda in Caracas and has taken extensive courses in technical analysis for fixed income markets given by the New York Institute of Finance. In addition, he holds the following licenses and registrations overseen by the Financial Industry Regulatory Authority, or FINRA. He has a Series 7 General Securities Representative GS, Series 24 General Securities Representative GP, Series 65 Uniform Investment Advisor Law. So without further ado, ladies and gentlemen, Mr. Jose Pedreira. Thank you very much.
Thank you very much, Sarah, for the introduction. So I guess I already have the share screen.
Yes.
Oh.
You just have to share it now.
Very good. Here we are. Okay, so first of all, good day, everyone. I hope you had a wonderful holiday season and a happy and healthy 2021. I'd like to thank the Boca Chamber of Commerce and the International Business Alliance for allowing me to share with you some of our global economic views for 2021. As the process of healing has started, we had identified 5 major points that I'd like to talk about today. The first one is, are we seeing the light at the end of a tunnel? And I think so. I'm sorry, as vaccines are being distributed around the globe, signaling the beginning of the end. Second point I'd like to talk about is that hopefully we are in a transition from a crisis to a recovery. The effects of the pandemic will be felt for years to come. The cost of almost 2 million lives, the most severe economic contractions since the Great Depression, the outcomes of the presidential election, and demonstrations worldwide emphasizing major inequalities has taken a major toll in world economies. The third I'd like to talk about today is also the global economy, and it will continue to heal from the pandemic. We already have experienced some of that recovery upward trend in 2020, as we saw the markets rebounding for the second half of the year. And we believe that emerging economies will likely be the driver of the uptrend, followed by developed economies in the second half of 2021. Fourth is risks, and risks will be driven by uncertainty. And potential examples of those risks are elimination of economic stimulus, governments providing inadequate policy support, and geopolitical disruptions. However, there will be opportunities as the economies continue to rebound. And the fifth is opportunities. They will arise from a stabilization of global economies as disruptions experienced during 2020 will be in the past, bringing momentum for markets to continue to recover. We believe there will be a strong global growth as economies reopen, but also there will be volatility as we're not completely out of the woods. We are in a transition, and to the extent that the vaccines are rolled out and distributed, this will change consumer behavior in a monumental way. If people feel comfortable returning to activities that they haven't done for almost 12 months and re-engaging in the economy, it will be a major impact for bringing demand for things like restaurants, dining indoors as well as outdoors, travel and entertainment, and all the types of experience-based spending, which has really been reduced as a result of a pandemic. So the vaccine is a big part of what we look ahead to 2021. Consumers have been resilient and businesses are embracing new technology. All things considered, confidence levels have remained reasonably well supported. The same with businesses. We all have seen a lot of dynamic behavior among businesses, with new businesses applications rising and with a real move towards more innovation and embracing of technology. Example we were talking early on is what we're doing today. I mean, having this Zoom call. But to get to the next stage of a cycle recovery, I think it will require people and businesses feeling free to invest openly and to spend without a concern about the resurgence of the virus. So once again, it goes back to the vaccine. The extent to which the vaccine is distributed, implemented, and changes people's risk tolerance in a positive way will result in business having a path forward in terms of how to invest and how to prepare for the future. And obviously, consumers can go out and spend and re-engage as well. There has been a massive shift of spending after an initial rise in savings. I mean, the fact that we were all at homes, we couldn't spend what probably we wanted to spend. But there are still other areas like travel, leisure, entertainment, and other service industries that are hurting and waiting for the post-vaccine environment to begin. Last year was fascinating in terms of the diversity of spending patterns. We saw initially a very strong stock-up mentality where consumer staples was a big beneficiary. We couldn't find toilet paper, we couldn't find wipes, we couldn't find a lot of things that were consumer staples. And that was a result of a panic around the lockdown and the stay-at-home mandates. Air travel and service areas of the economy, such as hotels, restaurants, education, banking, etc., suffered the most. Real estate was another sector that started to get harder with the social mandates progress, but it has recovered substantially over the last few months. And a shift from brick and mortar spending to online spending was really accelerated by COVID. Telecommuting, which is something we are all doing now, was another trend that is strongly accelerated by stay-at-home mandates. So it was interesting to see some trends really accelerated and others we think are going to change once we get to a reopening of the economy. In terms of the government policies with respect to what the governments are doing and the responses to the pandemic, in Asia, we see some levels of need for additional stimulus. China was able to contain the virus relatively quickly and effectively. It was therefore less dependent on monetary and fiscal policy to help bridge the economic gap that lockdowns created. Europe, on the other hand, faces challenges in providing adequate policy support. Interest rates already are negative and asset purchase programs are close to self-imposed limits. Given the limitations of the European Central Bank, the Eurozone seems to be more dependent on fiscal support to generate positive growth results. In Latin America, central banks aggressively cut interest rates to unprecedented levels, like much of the rest of the world. But countries throughout the region have limited fiscal policy room. In the US, the policy is a mix of monetary and fiscal support. The Federal Reserve has shifted towards an average inflation targeting framework, which means it wants employment to reach maximum levels and inflation to average 2%. To achieve this goal, the Fed has set interest rates at zero and is buying $120 billion worth of treasury bonds and mortgage-backed securities per month. The Fed has committed to not raising interest rates until the employment and inflation targets are met, which could be years away though. On the fiscal side, the CARES Act came with a $2.2 trillion price tag, which is more than double of the support that was provided after the 2008 global financial crisis. An additional stimulus package just recently approved, worth around $900 billion, will include support for state and local governments and bigger employment insurance. Such a package, critical for the workers and businesses that are still suffering, will likely be enough to ensure the recovery continues. All this is very supportive of risk assets and will bring good investment opportunities. What is the legacy of a pandemic? Healthcare has become a focal point for governments, so there will be a lot more spending there. Think also the digital global economy exploding because we're all working more remotely. And then think about the manufacturing services and the automation and the increased productivity. Telemedicine, remote education, working from home, how we travel, etc. We're going to look back when we look forward. We're going to see more universities go more remote with their students. And then when it comes to automation, delivery, and logistics, we are just at the beginning of a whole new renaissance in how we will deliver goods, how we consume goods, and how we travel. So with 2020 in the rearview mirror, we need to see the delivery of the vaccine that effectively gets to everybody and quickly. We need to see that the world economy reopens, and we need to see some sort of resumption of normality. In terms of the opportunities for investing in 2021, we have the following recommendations. There's going to be tremendous opportunities for long-term investors to capitalize on market pullbacks. And I'm sure there's going to be some of those. If not, look back at the market when it fell in March of last year. There was a tremendous buying opportunity there. You had to add exposure to areas of interest in your portfolios, and similarly, take gains in areas of the market that might have heated up too quickly. Have discipline and not be pushed and pulled by the headlines or whatever is happening today in the market. Navigate the volatility. I still believe, that core bonds provide the most effective and efficient way to dampen volatility in some of the portfolios. But we believe other asset classes and vehicles such as hedge funds should be included as well. Follow the mega trends. Which stocks are most likely to double, triple, quadruple, or more in the next few years? We think the best place to look at are in these three mega trends: digital transformation, healthcare innovation, and sustainability. Currency diversification is also important because we expect the US dollar to weaken modestly as the global economy continues to heal. Investors should consider diversifying the portfolios to gain exposure to assets denominated in other currencies, and that includes cryptocurrencies or Bitcoin. And look for diamonds in the rough. Overlooked markets could provide opportunity for outsized returns. Despite the risks surrounding some of the municipal finances, we are positive on select high-yield municipal bonds in the US, given attractive valuations and compelling relative yields. However, there is the elephant in the room, and that is inflation. Most analysts expect inflation to rise modestly over the next 12 to 18 months to just below 2% in the US and around 1% in Europe, right where it has been most of the last cycle. This means that interest rates will remain anchored, and investors should be worried of holding excess cash. However, if inflation will rise too quickly, it will pose risk for bonds. I will show you now some charts that will make the case for some concerns for inflation. On this very first chart that I'm showing here, we look at the US public debt. So concern for inflation is not unfounded, especially given the amount of stimulus that has been created since the 2008 financial crisis. I mean, if you look at the debt growth over the last 15 years, from 2007, $8 trillion to almost $28 trillion today, that is a concern for inflation. On this next chart, the same applies to the total, GDP to debt, total debt to GDP on a percentage basis. You can see that debt has grown exponentially, and GDP sort of have remained relatively stable. So we've grown from 60% total debt to GDP to 130 and 135 at the peak percent of debt to GDP. On this chart, we look at inflation, and at the GDP percentage change year on year. So we see that during the financial crisis of global financial crisis, we took a major hit on the GDP growth, and now 2020 was a major blow to GDP growth at the worst time of the worst of the pandemic. The GDP was negative 8%. We had a V recovery immediately, and again, as GDP has taken a toll, but fiscal and monetary policy stimulus and consumer re-engaging the economy, we believe should provide a backdrop for a strong recovery in 2021. On this next chart, which is another one that could potentially show a little bit of a concern, it's money supply. And you see money supply exponentially growing 400% over the past 15 years. So basically, and if you look at how the growth was in 2020, provided by the stimulus packages, all the 2.2 trillion and now the 900 billion that is coming about, that creates a lot of money supply that eventually will channel through inflation. So yeah, there has to be a concern on that. However, if you look at this chart, for the past 15 years, inflation has been pretty much under control, growing at an annual percent of 1.86, which is 1.86%, which is right on target. So it's difficult to say when inflation is going to have an impact, but we have to be worried that it could potentially be there. And with this being the last of the slides, I like to open it for a Q&A if there are any questions. Thank you.
So there you go. So anybody, you're welcome to just start asking questions. You would just unmute yourself. Where's Marisol? I'm sorry, we have so many on the call today that I can't see everyone in one page.
She's on.
Okay. All right, did anybody
I have a question. Sorry.
No, okay.
I have these things. Jose, we were discussing about the inflation and all these things. What effects do you see specifically to South Florida, and what do you think the small business owners can expect and how they can protect themselves after a year that has been of many, many losses?
Well, that's a challenging question because the same way small businesses can protect themselves, it's directly related to how the economy will grow. In terms of inflation, at the end of the day, inflation, if it comes and it spikes up, which, as I mentioned, given what the fiscal and monetary policies have been doing, I mean, the governments have been doing in terms of fiscal and monetary policy might not take an immediate effect. It will definitely take an effect down the road. But in the immediate future, that concern for inflation will not necessarily be a negative impact for small businesses. Quite the opposite, because of the growth in the money supply. That will probably get directed to more consumption, and it will affect positively the small businesses throughout the region.
All right, any other questions? Abilio,
Yes, can you see me?
yes, I can.
Can you hear me?
Yes, we can hear you.
We can hear you.
Jose, you mentioned Bitcoin quickly. Could you explain to us a little bit more about what you mean by that?
Well, I mean, if it is a true concern, I mean, there are two things that I mentioned Bitcoin for two reasons. One, it's given the amount of money that is being printed by the major economies, fiat currencies, which are known as the US dollar or the euros, whatever it's issued by the countries, could potentially be in danger. That if you add the fact that inflation down the road could be a major concern, well, then the value of those fiat currencies will depreciate over time. This is not, I mean, something that is not going to happen immediately, even though if you look at what has been going on with cryptocurrencies, especially with Bitcoin in the last couple of months, I mean, has been showing some real growth. But the concern is how you hold value, and you know, Bitcoin, I think, I mean, and this is why I mentioned Bitcoin, will hold value more down the road than other real assets like such as gold, for instance. So the concern again is fiat currencies are going to depreciate substantially because of the amount of money supply that is out there, because the governments continue to print money in order to be able to finance the stimulus packages that they're coming up with, and that definitely will create, you know, a concern. And then the other problem that could potentially be a concern down the road as well is if the US dollar loses the value of the commercial currency of the world. And there has been some discussions about that. Some countries are already taking other currencies as the commercial currencies. And so, I mean, given all those concerns, Bitcoin could potentially be, and I say Bitcoin more than any of the other cryptocurrencies because I think it's the one that could potentially survive if there is an explosion of those cryptocurrencies. And then on the same token, we have seen more of a shift from institutional investors moving in the same direction as well. They're investing more, I wouldn't say aggressively, but in the same way of people were looking at gold during the gold standard era in the late 30s, 40s. I believe some of those institutional investors, smart money, is looking at cryptocurrencies nowadays.
Jose, what about the safety concerns?
Well, yeah, there is obviously, if you have seen what is being, you know, happening in the past in terms of custody, I mean, obviously, the safety concern, it will be similar or equivalent to, you know, your dollar bill, or if you buy, you know, gold, instead of buying shares of gold, you buy the underlying asset. You buy a gold coin or whatever. So you have to be careful where you store that. And there are mechanisms to store Bitcoin in the same way. The the concern has been because there are exchanges that are basically create the effect of a custodian bank, and those exchanges have been hacked, and the bitcoins or the cryptocurrencies have been basically stolen. So that has been a major concern. So we have to be careful, obviously, with that. But there are mechanisms out there that will provide the safe custody of those cryptocurrencies in the same manner that you will provide for a safe custody of your gold coin.
Daniel, did you have something? Because I saw you turn your camera on.
You hear me?
Yeah.
So, Jose, I just wanted to ask you, what's the perspective on when the consumption, assuming that the vaccine is a hit, and that's a big if, when the consumption will come back to pre-COVID levels, I would say 2019 levels?
Well, you see, I mean, already started. I mean, 2020, it already started to see some of that trend. I mean, it has shifted from, as I said before, from the regular brick and mortar to more online spending. I mean, you look what happened in Black Friday, Amazon event. You look what happened, during the Christmas. You look what happened, and it was blowing the amounts of money that was spent through online purchases. So that is already happening. The problem is, how is it going to get to, still the brick and mortar, some of the economy that does not take advantage of the online economy. So, I mean, like restaurants, as I said, like air travel and whatnot. That definitely, it has to do with the vaccine, and it has to do with the fact that people feel comfortable that they're somehow immunized, and they will be able to, travel freely, go to restaurants, enjoy getting back together. And that's going to take some time. I think potentially you're going to start seeing some of that already happening, but the peak, going back to what the pre-COVID levels was, I think it's going to be a year and a half, 2 years from now.
All right. I know, Elliot, you had a question? Oh, let's unmute you. All right.
My question is, how quickly do you think Europe will be ready to welcome travelers? They're going through a tough time right now. A lot of people go to Europe on a regular basis. How is the infrastructure set up? Do you think they're ready to accept travelers this summer, or what process will they have to go through?
Well, again, it goes down to the vaccination process, and rolling down of the vaccines and getting people vaccinated, and hopefully people more than less want to get vaccinated as well. I mean, at the beginning there was rumors of at least 30% of the population that in developed countries that didn't want to get the vaccine. So some of these countries are going to open, but they're going to open conditionally to one, making sure that travelers have taken the vaccine, and somehow they are immunized of the potential spreading of the virus. So the infrastructure they have is there. I mean, like similar to the infrastructure that we have in here in terms of rolling out of the vaccines. The pharmaceutical companies are working 24/7 in order to produce enough vaccines to get distributed. The problem has been implementation, and we've been seeing that, and the implementation has been relatively slow. I mean, number was supposed to be 20 million people vaccinated before the end of the year in the US, and it was not even 10% of that. So I guess summer is not necessarily the timing that is gonna be a good timing to start traveling. I think we have to play by ear, but I think it's gonna take longer.
Okay, thank you.
All right, Armando, you had your hand raised.
Yes, thank you. Jose, actually, there's two questions. One is, what about the real estate? On one hand, we have the lowest interest rates in, I think, 40 years. But on the other, the liquidity of the market is far from the best, I would say. So is it more a seller's market, more a buyer's market? And the other one is what's related to one of Marisol's questions. Would this be a good time to start a small business?
Okay, on the first one, real estate, and I noticed that there are several people in the call that are associated or have real estate background. My take on real estate is that this is a buyer's market. I mean, for two reasons. One, you just said low interest rate environment. Two, actually, I would say it's more than two reasons, three reasons. Two, real estate got negatively impacted during the pandemic. There has been a shift, especially in the big cities. I mean, people that were living in small apartments, you see, what happened in New York, and you see what happened around the surroundings of New York, Connecticut and New Jersey and whatnot. People were moving away from the city into houses with a little more space in the suburbs, and that created a huge demand for houses, and obviously prices went up. So you have a negative impact on apartments in Manhattan, and you have a positive impact on houses in the suburbs. But in assuming that we will get to some type of normalcy within the next 12 to 24 months, definitely some of these areas that got hammered aggressively in terms of pricing for real estate, they're going to come back, and I think it's an opportunity. And then the third one is inflation. So if you look at the concern of inflation down the road, that potentially inflation can be there much bigger than what everybody is expecting or anticipating. Well, real estate is a real asset, and it will maintain its value in an inflationary environment. So I think it's a buyer's market. That was your question. It's a buyer's market now. The second question, I'm not so sure. I mean, it all depends on what type of business you want to get involved with. If it is your typical brick and mortar, I will not open a restaurant now. That's the reality. If it is something that you can use the technology, definitely I will look into it. Logistics, I think it's a business that still has a lot of room to grow. It has grown dramatically during the pandemic, but I still believe it has a lot of room to grow. And anything that you don't need to have physical presence could potentially be a good business. But then again, if you embrace the technology, there are some brick and mortar business that could be replicated online. So, think about, for instance, a gym. So you're not going to have gym open because obviously, social distancing and whatnot, it gets complicated, but you might be able to use technology to come up with things like, videos or classes online or whatever that people will be able to adapt. So it depends, on the business, and you have to definitely embrace technology.
Right. I know, Haney, you have a question? I'll unmute you or ask to unmute you. Okay.
Yeah, thank you. Actually, yeah, Jose, thanks very much for the presentation. I'd appreciate if you could comment a bit on the health of the global banking system, if you would. Very little has been said in the press. I'm sure everybody has their issues they're dealing with internationally. And secondly, if you could highlight any particular upcoming meetings or decisions that may have some serious impact on the global economy coming up that we should look for. Thank you.
Okay. Well, in terms of global banking, there has been, I mean, the recovery from the 2008 financial crisis was not 100% there. I mean, some banks did recover, some large financial institutions globally did recover, some others did not. Some others are still walking on eggshells. And with the pandemic, that basically made things even worse. And then you have to add the fact that, you know, I mean, there are two things. One is obviously the stimulus packages that the governments have been creating around the globe that have been somehow benefiting the banks. And then the impact of the pandemic, the negative impact on the pandemic, how has also affected the banks on a negative way. So we saw at the very beginning of the pandemic, during, I mean, the first 2-3 months, the major sell-off in March, banks got hammered. I mean, they got hit in a big way. I mean, bank stocks, they got really hammered. Then they recover somehow, but then there is still concerns as to, you know, what sort of portfolios they might have to write down, especially some of the commercial real estate that they are financing, and in places that obviously, you know, got impacted the most. So, I mean, I think it's fragile still, and you know, the fact that the Federal Reserve, through the mechanisms of buying $120 billion worth of treasury notes and mortgage-backed securities, and actually I just mentioned those two, during the heap of the crisis back in April last year, they were buying everything. I mean, the Fed basically, you know, was buying everything that was out there. So they recover. You know, are they healthy? I guess they're not healthy, but the governments wouldn't let them go at this point. I mean, I don't think you're going to see a major financial institution falling apart now. In terms of, I don't know if that answered your question. In terms of meetings or discussions, well, we have to see what's going to happen here in the U.S. We're going to see what's going to happen once the new government takes place. If hopefully everything goes smooth and tomorrow there are no hiccups, which, I mean, if there are hiccups, could also be an opportunity to get involved. As I said, you know, in the presentation, but we had to be very open to what the Biden government is going to do in terms of financial and fiscal stimulus. I read a couple of days ago that, you know, $900 billion that just passed, which is the new program that got approved a few days ago. It's a lot of money, but apparently they say that it's not enough, and they're looking to potentially do 3 times that. So that would be $3 trillion, and that would be scary as well. I mean, that would be really scary. So we had to keep an eye and see what happens. And then the fact that there's not going to be any tax increases. Yes, there will be tax increases. I mean, there's no way that the government is going to be able to finance all these stimulus packages with current tax regime, and there's going to be, you know, an impact on everybody's pockets down the road. In Europe, we had seen, you know, interesting. Well, we already have the UK out of the European Union, so they're on the run now. Pretty much the Brexit finished, and we had to see how it's going to evolve over the next months as well. And then in Asia, things have been pretty much under control. If it was a region in the world that controlled the whole situation relatively well, from the pandemic to the finances to providing enough stimulus not to make a major concern in terms of inflationary pressures down the road, to the safety net of their people was in Asia. And then the markets also reacted accordingly. If you see how the markets behave in Asia vis-a-vis the rest of the world, they behave in a much efficient way.
Well, thank you. I guess we have time, if necessary, if we have one more question. Let me make sure I don't see any hands raised. All right. Well, thank you so very much. It's interesting, as the very end of what you said about Asia and how they're handling things. That I have not heard enough about how they're handling things. So it's, I personally want to learn more about that and how they've handled not just the pandemic, but even the stimulus and things like that. So got me thinking. So I appreciate all of your knowledge. I appreciate the questions too. People had some really good questions today, which then even expanded the conversation. So thank you very much for taking the time. And
thank you for inviting me.
Absolutely. And we'll see more of you. I know we were talking before about, you haven't traveled since March. You were probably on a plane a lot more than the rest of us before the pandemic hit. So, welcome to staying in Boca for almost a year, but sooner, hopefully, rather than later, we'll be getting back on planes.
Yeah, that would be the idea.
Absolutely. Well, thank you all for coming. I do appreciate it. We do have our in-person breakfast for those of you that are venturing out a little bit. We have an in-person breakfast next Thursday, the 14th, at the Marriott. We did have an in-person breakfast last month. We keep it very, very limited, so I can see people are already registering. I'm able to see who's registering, and I believe we have to cap it at 80 people. So if you are interested or planning on attending, please register now. Don't wait, because we're only having, I believe, 4 people to a table, and space is limited. But we have followed protocol and feel very comfortable about that. So if anyone's interested in attending that, we're going to have an in-person SWIB, our Successful Women in Business lunch at the end of the month. So watch for that as well. We have a great speaker who's probably a friend of some of you. So I'm not going to tell you, I'm going to make you watch for the emails. Other than that, again, welcome to 2021. I look forward to an awesome year. I know we learned a lot. Everyone, all the memes talking about 2020 and how terrible it was. I know, having talked to a lot of you throughout the year, we're all a little bit better because of 2020 as well. So we can't forget the things that we've learned this last 12 months and bring that into 2021 as we come out of this pandemic. So looking forward to a prosperous 2021 and to seeing you all in person soon and giving those hugs and those passing out business cards and handshakes. So thank you all, and we'll see you next time. Take care. Bye-bye.